Ladies and gentlemen, good day and welcome to the maiden earnings conference call of Tega Industries Limited, organized by Orient Capital. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mehul Mohanka, Managing Director and Group CEO. Thank you, and over to you, sir.
Thank you. Good afternoon and a warm welcome to all the participants. I'm joined today on this call by my colleagues, Mr. Manoj Agarwal, the CFO of the company, and Mr. Yaver Imam, who's the Director of Global Product Group, as well as Orient Capital, our investor relations partner. It is our maiden earnings call today after the initial public offering. As you all know, the company listed on the Indian bourses on the 13th of December 2021. I hope by now all of you have had the opportunity to go through our financial results and investor presentations, which have been uploaded on the stock exchanges as well as our company website. Before we get to the Q3 performance, I would like to thank everyone for supporting the IPO of the company. With your support and trust, the IPO was oversubscribed by almost 219 times. Since this is the first call, there are some of you with whom we will be interacting for the first time, and hence I would like to take this opportunity to quickly give you a short, brief description about the company. So Tega commenced operations in 1978 in India with a foreign collaboration with Tega of Sweden, with an objective of providing unique products and services for handling complex problems in material handling and mineral processing. We are the leading manufacturer and distributor of specialized critical to operate and recurring consumable products catering to global mineral beneficiation, mining, and bulk solids handling industries. We are the second largest producer of polymer-based mill linings, as well as one of the largest players providing hybrid liners across semi-autogenous and ball mills. We have close to 55 products in our portfolio spread across multiple geographies globally. Today we operate 6 manufacturing plants across the world, with 3 in India and 3 in overseas locations. And we have approximately 513 installations at different mine sites across the world. And as on financial year March 21, in about 17 countries with 18 global and 14 domestic sales offices across the world. And almost 85% of our revenues is generated outside of the country. From a macro industry data, mineral processing industry is set to grow at a CAGR of 6.3% between 2020 to 2030. Infrastructure growth, shift to EVs, electronics, volatility hedge, etc. are key demand drivers for relevant metals. Declining ore grade, enhancing demand for beneficiation products. Decreasing ore grades requires a higher throughput, which has led to greater demand for larger sized equipment as well as higher consumption of consumables. This is supported by the fact that our business is immune from capex cycles, and it caters to aftermarket spend for customers which has recurring revenue in nature. So all our products tend to be an operational expense for our clients. We drive continuous design innovation in all our products. As you all know, we launched the DynaPrime range of our products in 2018. It's a composite liner, which is first of its kind in the entire world. And this has helped us unlock new addressable markets for our company, which includes larger size mills, which offers greater productivity gains and cost savings for our customers, as well as almost a 50% increase in life compared to traditional steel linings. We have also embarked on inorganic strategy in the past. We've successfully integrated more than 3 acquisitions across the world. Some of the key growth drivers for us would be the demand for iron ore, copper, and other metals and minerals, which will drive the growth for the mineral processing equipment industry in time to come. We all know about the electric vehicle manufacturing, which will be top demand drivers for copper, aluminum, and other metals. EV, as we know, is now something which is synonymous with not only automobiles, but it is the future of our country. Global gold and copper concentrate production industry is likely to grow at a CAGR of 4.3% and 3.7% respectively between 2020 and 30. Gold and copper mill sites require superior quality of consumables and have higher beneficiation requirements. Owing to ore grade depletion, miners are required to process more ore to get the desired throughput, which will boost the demand for mineral processing equipment. Strong market position and entry barriers have helped us maintain high margins over time, with revenues from operations growing at about 12.74% CAGR during FY19-21. Reported operating EBITDA margin at 23.7% in FY21 has been successfully maintained this operating efficiency levels while completing and integrating acquisitions, JVs, and strategic alliances, including our acquisitions in South Africa, Australia, and Chile. In several cases, our relationships with key customers span for more than a decade, and it's a testimony to our business excellence. Our order book stands at about 278.1 crores as of December 31, 2021. Our strategies going forward is to increase our penetration and market share in North and South America, Australia, and South Africa, to grow our market share and share of customers' wallet with improving market penetration and cross-selling opportunities in high-quality products and solutions which have recurring demand and will lead to high repeat in revenues. We will continue to leverage our in-house R&D capabilities to grow our product offerings and capitalize on future trends. Our in-house R&D team focuses on upgrading our existing products and developing product variants on a continuous basis. We're going to continue to expand our manufacturing capabilities with planned expansions in our facilities in Dahej and in the Calcutta plant. We also are going to be setting up a new manufacturing facility in Chile, for which, as you know, the board has already given us an in-principle approval. We would also continue to enhance our operational efficiencies and increase economies of scale to strengthen our competitive position globally. With that, I would now like to hand over to Mr. Manoj Agrawal, our CFO, to take you through the financial performance of the company for Q3 and 9 months under review.
Thank you, Mr. Mohanka, and a very good evening to all the participants. I hope all of you and your families are in good health. I'll share the highlights of our performance for the quarter ending 31st December 2021, and following which we will be happy to respond to your queries. Quarter to quarter net revenue from operation is 257 crores for the quarter ending December 31st, 2021 against 214 crores previous year same period, delivering a growth of 20%. Operating EBITDA stood at 51 crores in quarter 3 FY22 as against 47 crores in quarter 3 FY21, a jump of 8%. Operating EBITDA margin stood at 20% as against 22% same period last year. The major impact on EBITDA for the quarter ending 31st December 2021 is due to higher input cost, which we need to transfer to the customer, which will take another quarter to pass it on. This is also impacted because of abnormal increase in logistic cost, which will again take some quarters to pass it on. Profit after tax increased to 33.5 crores for quarter 3 FY22 as against 31.5 crores in quarter 3 FY21. This is to be noted that non-operating income has gone down from 14 crores in December 20 quarter to 4 crores in December 21 quarter. Now we may open the floor for Q&A.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. first question is from Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, very good evening. So the first question is pertaining to the growth. If you can provide some more color as to how the liner business has grown versus the non-mill lining business, and within mill lining, how has the DynaPrime product range progressed in terms of growth? And also broadly, with this 20% growth, if you can briefly break it up into how much would be a realization increase driven, or rather how much realization increase you would require to pass through the cost increases that you just mentioned, and what has already been taken.
Thank you, Sandeep. This is Manoj. So if I just try to break up the revenue on a 20% growth, what we see about 10% is coming from the price and 10% coming from the volume. On the mill line side, the overall growth is about 20%, wherein the DynaPrime has grown at a rate of about 16%, and the mill liner without DynaPrime has grown about close to 30%. On the non-mill liner, as of now, the growth is virtually flat. It's about 1%, and overall growth is about 20% for the quarter December 21.
Okay, so DynaPrime, the growth rate has come up to 16%. Is it? If you could highlight what would be the major reasons for that?
So the growth has come mainly from the India side, where we have got some new orders from North America region, and we also able to expand ourselves in Africa, Western Africa region. So those two areas giving the kind of upswing in the DynaPrime segment, and that is coming with the fact that we have been doing the trial in many of the sites, and those trial is getting converted into commercial orders.
Okay. And on the non-mill lining side, you mentioned it is flat. So overall, if you could help us understand the math, because you mentioned mill lining has grown 20%, overall revenue is 20%. So non-mill lining revenues should not be ideally so low, right? For the average to be 20%.
Yeah. So what I said basically in the non-mill liner, DynaPrime has grown about 16%. Your non-mill mill liner without DynaPrime has grown about 25%, which gives to about 25% overall growth. And then the non-mill is coming about 1%. And if I take the project in the non-mill liner, because as you know that we also have the project under the non-mill business, which are not recurring in nature, unless the project got commissioned. So if I add the non-mill liner including project, the degrowth will be about close to -6, -7%. And if I remove the project business from the non-mill liner, it is about flat. And mill liner has grown substantially about to 25+%, taking DynaPrime and mill both together. Maybe I can share the breakup separately to you.
Sure, no worry. And second part of the question was on what kind of cost pass-throughs are you expecting over the next 2 quarters for both raw material and logistics, so that you are able to maintain the earlier level of margins around 20-20%?
So we are looking at 2 parts here. One is raw material. So we are confident that on raw material gap, which is about 2.5%, we will be able to pass it on. As far as logistics is concerned, which we know that is abnormally high, so it's more of that we will be able to pass through some bit of it in coming quarters, but may not all the logistic costs. So maybe one part is we can pass it to the customers, and how much the cost get normalized in the coming quarters. But this is the current situation. What we see that logistic cost will take another 2 to 3 quarters to kind of comes to a lower trajectory. So there is a challenge to pass on the entire gap of logistic cost to the customer, and if logistic cost doesn't kind of comes to downtrend, that gap may be there for that period.
Understood. And last question on DynaPrime per se. Currently, if you can give some trajectory as to at how many sites the trials are on currently, and based on whatever your expectation is on the conversion rate, what is the average revenue per site can you grow to, and what should be the total growth in DynaPrime over the next 2 to 3 years?
So Sandeep, actually it is very difficult to give some kind of forecasting in this call basically, so we can't talk about that forecasting per se. But what we can say that trial is running on in various sites globally, and that will take up the growth trajectory as far as DynaPrime is concerned.
Okay, all right, understood. Thank you so much for taking the question.
Thank you, Sandeep.
Thank you. The next question is from the line of Abhishek Poddar from HDFC Asset Management. Please go ahead.
Thank you. Congratulations on good quarter. Sir, is it possible to give the revenue split for DynaPrime? Percentage of revenue is coming from DynaPrime? Hello?
Just a second, please.
Yeah, sure.
Percent.
Or any absolute number if you can throw, either way.
So it is about 19% of the total revenue, 19.
Okay, and you would expect that this 19% should grow faster, so that percentage will increase in going forward in next 2-3 years.
So as I said that we are expecting our growth trajectory from DynaPrime obviously going forward. So DynaPrime will take the growth forward for the company.
Understood. And this raw material gap of 2.5%, this is the commodity price inflation that you have not been able to pass on to customers, is what you're referring to?
Yeah, so generally we tend to target about 60% raw material margin in our business, right? And what we're finding that there's a still gap of about 2.5 to 3%. And we believe that it will take another 2 quarters to pass it on, as I said in my earlier query. And so raw material cost will be able to pass it on. It may take one or 2 more quarters, but there is challenging logistic cost as of now.
Okay, understood. And in the other expenses, is there any forex loss in this quarter?
Not as such.
Okay. So trying to understand that how the forex has impacted your last year's margin and this year's margin.
So this year, more or less, the forex impact is not there, which was there last year. So on the plus minus side, it is more of getting nullified in terms of impact on the P&L account. So hardly, if I talk about the number, the P&L account is coming about close to hardly about net 13 lakhs rupees.
For this quarter?
For 9 months. For this quarter is about 78 lakhs.
Okay, understood, sir. And just last question, any comments on the demand outlook in the overseas market from the mining industry?
Yeah, I'll just request Mr. Yamal Imam to speak on that.
Hi. As far as mining industry is concerned, in the last 10 months, copper production has increased somewhere around by 4.1%. And similarly, gold gold latest figures are up to H1 of last year. So there also the growth has been 9%. So as far as copper and gold is concerned, as far as the production is concerned, there has been, it is more or less following the projections that were there, given earlier as far as the growth is concerned. So the demand both from gold as well as copper is on the rise.
Okay, thank you, sir.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. Next question is from the line of Bharti Sawant from Mirae Asset. Please go ahead.
Yeah, thank you for taking the question. So a couple of questions. First of all, you mentioned that the overall pricing growth for you was 10%.
Sorry to interrupt you, but your voice is very low. Can you speak louder, please?
Yeah, is it better?
Yes, please go ahead.
Yeah. So I wanted to understand what kind of RM inflation have we seen, and are we seeing a trend of moderation in the RM prices? Because despite of 10% pricing growth, we've still seen our gross margin compress. Hello?
We can't hear you, Bharti. Can you repeat the question?
Hello? Is this better?
Yeah.
Yeah. So what I wanted to understand is, you mentioned that the overall growth in revenues of the 20%, 10% is driven by pricing. So what kind of RM inflation are we seeing? And is there a trend that the RM prices are kind of moderating and we should see an improvement in margins going forward just on account of RM?
So on the RM side, what we are seeing from last 2-3 months, that it is getting flattened down. So we're not seeing any upswing which was there in the last 3 quarters, other than the quarter 3. So this is a good news for us in terms of not going to increase every time to the customers. Now from here, if it goes on an upward trajectory, then obviously it may have some impact. But as we said that when we talk about pass-through works both the sides. We can't talk about pass-through on the upward trend, not the downward trend. And if prices goes down again, drastically again, we need to pass it on to customers also. So ultimate objective of ours to stay at least at 60% RM margin and plus minus 1-2%.
So the key increase in the raw material cost could it have been more like 14-15%? Because despite of taking a 10% price hike, we are not able to pass on the RM cost. So would it be that steep?
Yeah. It is that sharp. Even more than that also.
And also in terms of this 10% pricing, so can you just explain us what would be the role of product change which will drive the realizations?
So one is the price, one is the product mix. So basically product mix got normalized in quarter 3, quarter 4, may not be quarter 1, quarter 2. And again, price depends on the local landscape of the competition, customer, kind of acceptance. So there are a lot of levers to decide on the price part, though it is a critical to spares. But again, it is being based on the geography, customer to customer.
Okay. Also, just dwelling more on the expense front. So we have seen significant increase in the first 9 months. We have seen a significant increase in the employee cost as well as your other expenses. Unlike the past 3 years, wherein both these costs were quite benign. So would you like to throw some light as to where should this number stabilize, and given that we are targeting growth of closer to 14-15% CAGR, so can we expect a similar growth in the employee cost, or should it remain benign?
No, it will remain benign now because as we told earlier also that in our business we have to build up our team year and 2 in advance. So what we believe, because last year also because of COVID period, the intent was to preserve cash and not to spend money. So we have not done per se hiring last year. So most of the hiring is happening this year itself, so that we can take the growth from the next couple of years. So what we believe that whatever trajectory is going in today's employee cost, that will not be in the same proportion going forward. So it will be kind of benign, going forward as far as employee cost is concerned.
Okay. And also in terms of other expenses?
Other expenses, as I said, because there are 3-4 main items there, like I said, logistic cost, right, which is about 20 crores on 9 months to 9 months, which has something very abnormal. And then we have some repair and maintenance which we have stopped last year, again because of COVID and cost preservation. We talk about 5 crores and about logistic 20 crores. And we have about close to traveling also been started, which was absolutely not there previous years. So that impact also is coming. So taking 4-5 bigger items, it's coming now to that differences basically. And then the other volume and price growths are there in the other expenses.
Okay. And just last question from my side on the non-mill products, non-mill lining products. So given that earlier we have highlighted that our strategy is to increase the wallet share by increasing the products that we are supplying it to the consumers or to our mining customers. So, but given the way non-mill lining products have been performing, like flattish number for the current quarter, I don't know what that number is for the 9 months. So, what strategy are we adopting to push more sales or to increase the contribution from the mill lining products? If you can just highlight that.
Amisha, you can take it.
Yeah, I think the issue which we had discussed earlier also was on the increase of wallet share on acquired customers. So what we are looking at in the short-term strategy, which will be effective for the next 2 to 3 years, is that Dynaprime, the large customers that we are acquiring now, once we stabilize the customer from going through the trial and making them on board with regular supplies, thereafter we are looking at expanding their product portfolio with the non-mill products. And this is already in operation in Chile, where if you will look at the non-mill growth, we will find good growth over there. And going forward, once we acquire the larger customers in the rest of the world, this will happen. So it's a question of 1 or 2 years lag with the acquisition of customers for Dynaprime, where the following would be the rest of the product to gain market share and wallet share there.
And also, while acquiring customers for Dynaprime, so what strategy do we adopt? Is it more led by pricing, or do we still earn margins on or during the trial period?
We earn margin on trial. I think even the trial period orders with the Dynaprime, we are close to somewhere around gross margin of close to around 55 to 58%. Okay, it's not too far off. The basic idea is that we are changing from steel liner. We go in with the value proposition and look at it. So the changes which will come in once we go into a full application at site will bring us back to around 60% gross margin. So that is the range in which we are playing with Dynaprime as far as the product lines are concerned.
Okay. And
sorry to interrupt, but
one last
we
question.
request you to return to the queue, ma'am. We have several participants in the queue.
Sure.
Thank you. Our next question is from the line of Ashleka, an individual investor. Please go ahead. Hello.
Good afternoon, team. Congratulations on getting listed, and thanks for the opportunity. I went through your presentation, which helped me get an idea of your business model, and I appreciate the company's rich legacy. So I have 2 questions. First, what is the expected timeline on expansion in Chile? And my second question is, what services do we provide in life cycle management?
So the timeline for the plant to be set up in Chile is within 24 months. The internal estimate is to try and aim for 18, but the attempt is to do it within 24 months. When we talk about life cycle management, it's to do with providing services to customers, which includes monitoring the performance of the product using laser scanning technology, providing constant performance reports to customers, aiding in installation of our product, and also providing customers with opportunities to save on downtime of the equipment by improving the speed with which the products are installed. So those are part of our life cycle management services.
Participants, it seems we have lost the line for the current question. We'll move to our next question, which is from the line of Abhishek Jain from Analyst Capital. Please go ahead.
So thank you for taking my question. First thing, sir, Dynaprime thing, if you can explain in detail how big can be the opportunity is there right now, and what is our product differentiation. Second, as earlier participant has discussed, you have said, what can be the margins we should take it for next 2-3 years down the line on the stable state margin. And third, if you could throw light on the Chile business right now. And after the new capacity, what kind of revenues we are looking out?
So, as far as the Dynaprime opportunity is concerned, it is close to around $900 million. Okay, and globally, when we are looking at this, the growth in the Dynaprime will come from this 900 million section. What was your second question, please? The margin as well is there is as I said before also, it is more or less the same gross margin we are looking at, and our aim is to be at 60% gross margin as far as Dynaprime is concerned also. Oh. Chile, the project that is being set up, as of now, we are running close to capacity in Chile for the next year. So the idea is that the growth opportunity that have been put in and the trials that are in working in Chile now, which will get into operational and commercial business. By that time, we should get the plant up and ready. The plant that we are looking at, we presently have, we will be doubling our capacity in Chile, and that is what we plan to see to get the growth from there.
How much is our current capacity in the Chile right now, sir? And
capacity. Can you repeat? Your voice is breaking.
What is our current capacity in Chile right now? How much revenue we are doing in Chile at this point of time, sir?
So current capacity of breaking two parts. On Dynaprime side, we are close to about $30 million, 30. Okay. And this product is about close to $10 million. So as of today, we can go up to $40 million in a full scale.
Okay. And after this expansion, will be reaching around $80 million.
Yes, close to that.
Okay, sir. Thank you, sir. Thank you. Thank you.
Thank you very much. Next question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. Thanks for taking my question. First question, is it possible to share the 9 months growth number of Dynaprime?
I think what I shared earlier, it's a 9 month growth only about 16%, 16.
So sir, what is then in this quarter the Dynaprime growth is? What's the growth in Q3?
Q3, I'll come back to you. That Q3 growth numbers I don't have. I'll come back to you separately on it.
The question is, sir, it's very contradictory statement from two angles. One, you're saying the demand is very good. And at that time of the IPO also, you said Dynaprime is going to grow much ahead of the company's growth. So the question I want to understand is, if the 9 month figure is 16%, and I'm assuming the inflation should be about 10%, it's a very low single digit growth which has come up in the 9 months, assuming you don't have the numbers for Q3. What has led to this low growth, number one, and the demand is so strong and you're trying to penetrate into clients? Is it... Hello?
Hello? I think right from the beginning, even in the roadshow which we are there, we have been saying that, to look at our figures on a year-on-year basis, okay? Because both, and if you remember, I told you, okay, most of the large mining corporations have their year on year on the calendar year. So for us, especially for Dynaprime and all, would be big months in the next quarter than the recent. So overall, when you look at it, we have to look at what is the growth in the order booking, and then at the same time the pending order, as well as what will happen in the next quarter. So relevance of year-to-year growth would be more appropriate than to look at quarter to quarter or 3 quarters and look at that. Because Dynaprime mainly and the larger mills with life of 6 months and 12 months are in that period where it will be on the 4th quarter for us or 1st quarter of the year this thing. So when we look at that, I think that is the period we should look at it on the year-to-year growth. So what will happen at the end of the quarter, I think the figures would be more relevant to see.
So, sir, first of all, I asked a number only, which you only gave me, which is a 15% growth. So I never compared quarter on quarter. It's a good thing you told me Q4 is more of a heavy quarter. So if Q4 and you have a strong order backlog, let's say for the Dynaprime, is it safe to assume a 40% growth? What you stated at the time of the IPO, 35-40% growth for the Dynaprime this year?
So at the time of the IPO also, we were looking at 25 to 28% growth as far as Dynaprime is concerned. And from whatever the situation is today, we are on track on that.
All right. This is helpful. So second question, with respect to the cost arbitrage. So, you're already saying that 10% kind of a cost increase and we have passed on to the customer. And now this question is, one is a non-Dynaprime line business. If you can throw some light with respect to the pressure, is there some pressure on the market share? Because if you go beyond a certain price point, the local player gets little edge. If someone, let's say not an edge, let's say cost is increasing for everyone, but if someone wants to get higher market share, they can actually do it because of the supply chain. How you are tackling that? And second, in the Dynaprime, does the cost arbitrage between the steel liner and the Dynaprime has widened a lot in this commodity scenario? Those are the 2 questions. Thank you very much, sir.
No, the steel prices have been going up also. Okay, so it's not that the prices of Dynaprime is going up. So there are 2 parts of this when you are looking at it. When we look at passing on to the pricing, we are talking about 75% of our spare business where we are passing on the price business. The new business is a combination of what the customer is spending, what the competitive situation is, how we are getting the thing. Those are the new question of things. So when we look at most of the Dynaprime where we have the growth coming at 25-30% on that, then we look at the balance 75% where the price increases are being passed on to the customer. So where the steel is, yes, steel prices have gone up, and the margins we will look at the going according to what the steel prices are going up and our the 60% margin. The problem which you have rightly pointed out is the question in the non-Dynaprime mills, especially where the logistic cost becomes so high, it becomes the local supplier would become more. Now, for us, this is a challenge only in 2 territories because we have already covered Latin America, and Africa, and Australia and India through this thing. So the main geography which we are would be getting challenged in would be USA and Canada. USA and Canada, the margins on the existing business are such that we have to make a call on where to pass on what portion of this thing to pass on to the customer. So we are taking a call that the logistic cost somewhere in the near future would normalize. So in some of the cases, we take a call to hold the customer, and the logistic cost then gets passed on to a certain percentage, maybe not fully. So those are calls which we take. and which we do it overall to see that our margins on the gross level does not get affected. And as of today, the major challenge would be only in these two territories because the local manufacture in other places mitigates that problem.
Got it, sir. Thank you very much. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address queries from all participants in the call, please restrict your questions to the participants. Time permitting, you may return to the queue for a follow-up question. Next question is from the line of Chinmay Garg from Growing Capital. Please go ahead.
Hi, good afternoon. Can you hear me?
Yes, please.
Yeah. I just wanted to know, since the company is newly listed and we do not have a lot of history of numbers, is there some seasonality in business? You mentioned that Q4 would be big for Dynaprime, but for the rest of the business?
See, for us, the second half usually becomes, I think we have to look at the global mining companies and their shutdown schedules, Most of them are on a calendar year. So the second half of the calendar year, they are on a full production run. Would normally not try to have any shutdown periods over there. Okay. So for us, the third quarter and fourth quarter, where we get the order and start shipping to meet the schedules in the last quarter of ours and the first quarter of. So this is where the schedule. So for us, the third and fourth quarter becomes a heavy this thing in not only in Dynaprime, in most of the mill liner business, because the customers are timing their shutdowns to half where they are not ramping up production.
Understood. Okay. Thank you so much.
Thank you. Next question is from the line of Anurag Patil from Roha Asset Managers. Please go ahead.
Thank you for the opportunity. So how much capex we are doing for expanding Dahej and Samali?
Can you repeat the question, Anurag?
Yeah, sir, for Dahej and Samali plant expansion, how much will be spending?
So Samali plant is a very old plant per se, but Dahej is the latest one, and we have spent about close to 140 crores for Dahej plant.
Okay, so that expansion is complete as of now, right?
Yeah, that initial project was done in 2013, and that is the initial cost. And expansion will be doing from next year onwards. So that expansion will be close to about 9 to 10 million, taking Dahej and Samali together.
Okay. And sir, out of our total revenue, what percentage of constitutes the long-term contract related revenue and the spot revenue?
Generally, 25 to 30% is long-term revenue, long-term contract, generally.
Okay, and the rest is on the spot basis?
Yeah. So we used to get recurring orders, from the customers.
Okay, that's it. Thank you very much.
Thank you.
Thank you. Next question is from the line of Mithun Ashwath from Kiva Advisors. Please go ahead.
Hello. Just wanted to understand in terms of your order book, how is the order book grown? When you mentioned that visibility is reasonably good, just wanted to get a sense of how that has moved up. Hello.
Order book in this period has grown around 24%.
Right. And typically, how many months of business or would you have the order book, or is it a short cycle sort of a?
Usually, if you look at the pending order that we have, always it is a 3 months order booking for the next 3 months. So we usually are looking at order booking, which is because with our shipment and other schedule, this is the cycle that we have. So a quarter, we look at order booking for a quarter.
Right. And so every quarter you are able to reprice your products typically?
Yeah, most of it's not a quarter wise, it's an ongoing process. What happens is throughout the year, when the orders are getting negotiated and this thing, we look at what the prices have been and what is passed on. So when we talk about pass-through, usually 1 or 2 quarter it takes to pass on everything. So whatever is coming up in negotiation during 1 quarter, we continue to pass it on.
Right. No, I just wanted to get a sense because I think from your presentation there's about 270 or 280 crores of orders pending. So and also your margins have fluctuated through this year. So and there's been some improvement quarter on quarter. Do you see that trend of improvement on the margins on a quarter on quarter basis sustainable, or this would again depend on like you mentioned how the raw material fluctuation would go?
Yes, you are right. It depends on the raw material fluctuations. As I said that if now it has got flattened, if we find that there is no upward movement going forward, then we can reach to our 60% RMC margin in a quarter, 2 quarters going forward.
Right. Okay. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was our last question for today. I now hand the conference over to the management for closing remarks. Over to you, Jim.
Yeah, so I'd like to thank everyone for joining this call, and I hope we've been able to respond to your queries adequately. For those that we are to come back with additional information, we will do so shortly. For any further information, I would request you all to get in touch with Orient Capital, who are investor relations advisors. So once again, thank you for participating in this call, and we hope to see you again in the next quarter earnings call. Thank you.
Thank you very much, members of management. Mr. Kale, would you like to add any closing comments from your end, sir?
Yeah, thanks everybody for participating in the maiden Concall of Tega Industries. We look forward to continuous engagement with the markets and all the participants, and we would be more than happy to clarify further doubts and queries which you would have. Our contact numbers and email ID are also present on the company's presentation on the Excel. Thank you once again. Stay safe. Have a nice day.
Thanks very much, members of management and Mr. Kale. On behalf of Tega Industries Limited and Orient Capital, that concludes today's conference call. Thank you all for joining us, and you can now disconnect the lines.